Hello and welcome to another financial analysis video. Today I am covering IBM, which announced earnings after the bell, and they beat earnings by 4 cents a share. However, they cut guidance for 2015 by approximately, I'd say 6 to 7%. They gave a lower range than the prior. And in all honesty, consensus was actually under prior guidance. So while it's not the best of news for IBM, it really isn't that terrible. So I would consider it a 6% guidance cut from consensus. Shares after hours are approaching down about 5%. So believe it or not, for a long time I've not felt good about IBM, but at $140 a share, which is very close to where it'll be tomorrow, I'm feeling much better. I want to explain why. One, it's got a building dividend, and it's strong. It's going to approach 4% after this sell-off, but you have to look at the payout ratio, which is only 1/3 of earnings, and the cash commitment, which in the last 12 months is approximately $4.8 billion against a very strong $14.4 billion trailing 12-month free cash flow. So plenty of room there for dividends in the cash flow. Speaking of cash flow, it is kind of flat from a downward pattern. However, it is not dropping as much as the revenue is. And this is a company that is going through several different changes. But I'm going to tell you the biggest thing that makes me feel good now about IBM, and I guess I'm old-fashioned when I say this, it's the fact that it is coming off of what I considered some hot moments of leverage. Almost 9-to-1 leverage, now down to, I believe it's down to 7-to-1. So it's gone from 9-to-1 in the fourth quarter to 7-to-1 leverage currently. And I'll feel better when it gets down to 5-to-1 leverage, and I'll explain a little more here in a second. But the fact that this pattern has reversed makes me feel a lot better. It tells me the job cuts are working, and it tells me that the other efficiency measures that the company has taken are beginning to work. Returns. Interestingly enough, people may want to jump out of their seats when they see a company with 100% return on equity. This is because it's so over-leveraged. This number needs to come down with equity going up for me to feel anything better. Return on assets is what you want to focus on here, and it is modestly improving from its worst performance. It's going to approach 15%. This is the indicator you do want to watch as IBM continues to go through its changes. Return on equity, just too bloated with the over-leveraging. Earnings per share on a trailing 12-month basis down. It's probably going to be even weaker in the fourth quarter. Again, wait for the street to react to that. That's why I think 140, 135 are good entry points. And again, the earnings per share drop is not as bad as the revenue drop. Again, trying to find more efficiency there. But with all that being said, this is a company that's trading at 9 times trailing earnings and 9 times forward earnings. And so there's definitely been a lot of selling and a lot of downside pressure on IBM for a while now. And I think that some of the things they're doing are starting to work. So look for equity to improve. Look for the company to leverage. Obviously, return on equity is going to drop with that. Look for ROA to increase. And hopefully, earnings per share will normalize. I hope you enjoyed this video. Happy investing.